Okay, everyone. This session is going to be on common stock. Voting rights, stock splits and dividends, and forming the company. That's what we have to talk about. How it starts. All these corporations started with an owner somehow, somewhere. An individual or a group got together, and what did they do? They first go to their state to incorporate. Now, I understand that some may be sole proprietor and all that stuff, but we're talking about common stock, so it has to be incorporated, developed in the Secretary of State's office of the state they're going to incorporate in. So they file their articles of incorporation or a company charter, corporate charter, just depends on what the state calls it. And what they do originally is file the paperwork on who they are, but they're going to list how many authorized shares. How many authorized shares do they want to place? Well, they make it a big number. Let's say 10 million. That's not how many shares they're going to issue in the beginning. It shouldn't be. But the original owners are going to set up so many shares for themselves. That's required by law. The Secretary of State wants to know who owns what, how many shares. So now we're going to issue shares. And between all the owners, it'll be a much smaller number because later we want to use these shares possibly to raise more money or to go public. But let's just say in the beginning, we only do 400,000 shares. Possibly 100 through special employees to start the company at a lower wage, but they're going to get stock. And then 300,000 to the founders and all that stuff. But that's the idea. You have to list who owns what in your declaration to the Secretary of the State. Now, of that, we have outstanding shares. And that would be the same as the issued in the beginning. Okay? But let's say time goes on and two of the workers who have stock want to sell it back or they don't want it anymore. So the company agrees to buy the stock. Not me, I don't want it. I may be the biggest shareholder, but I don't want to pay it out. So the company will do it. That would be treasury stock. And let's say they wanted to buy back, they wanted to give up 40,000 shares that they had from these two employees that left. Well, we subtract that now from issued, and now we got 360,000 outstanding shares by the owners. They don't count the treasury stock once it's issued as part of the outstanding if the company buys it back. Now, why would a bigger company buy back their stock? If the markets drop significantly, if it's a bargain in the marketplace, that's one reason. The other is make it more attractive for new investors. So what happens if we're paying a dividend and we have good earnings and they're consistent? Well, they're not going to change just because the market's bad. Maybe it doesn't in this situation, but immediately when they buy all these shares back, now their calculations are based on 360,000. So earnings per share and the dividend yield, they all go up. Oh, and then there's the PE ratio. That goes down. The PE ratio is based on the price of the stock divided by the earnings. If the earnings per share went up, the PE ratio is going to go down because you have a bigger number down in the denominator, right? Okay, so logic. That's on the test. What's going to happen after treasury buyback? Okay. So what could they do with this treasury stock? They could provide it as a stock dividend to current stockholders, or they could just use it for an employee benefit program. Possibly, maybe they're going to do a merger or a joint venture with a company, and they'll say, hey, do this joint venture and we got 40,000 in common stock if you want. So there's a lot of things they can do with treasury stock. But now, let's say things are going around, things are going good, business is going well, and now we got to find out what they can do with their stock, what they can vote it. And how they vote it is statutory or cumulative. If they have, if an investor has 400 shares and the board and the proxy goes out and you can vote your 400 shares for, there's three, let's say there's 3 openings on the board of directors. There's 10 candidates. Of these 10 candidates, you got to elect 3. So the top 3 vote getters are going to get in on the board of directors. You have 400 shares. You have 400 votes here. Vote up to 400 vote 3 times. You can take your 400 votes and say 400 for this candidate, 400 for that candidate, 400 for this candidate over here. That's how you can vote. Or you can go 4 for 200, okay? But you can't go over 400 for any one candidate, and you get 3 candidate selections. Or maybe you just like one, fine. 400 goes to 1, and that's it. This really is irrelevant. How many candidates? Just trying to throw you off. Cumulative is voting differently. 3 candidates, 400 shares, 1,200 votes. Any way you want. You want it all for one candidate? That's fine. You want it spread over 4 candidates. You can do 300, 300, 300, 300. You can do 1,000, 100, and 100. However you want to do it. That's cumulative. This is designed to, on the test, they say the best answer is cumulative voting assists in bringing more support to a minority candidate. I think it's a crock, but that's the answer on the test. Why do I think that? Why did I say such a thing like that? Because, hey, if you got 400 votes, and everybody else is voting cumulatively too. So somebody with a lot of shares can vote the other person even more. So the concept is there, but for the test, just know that it can help put more emphasis to a minority vote. Okay? The smaller candidate, the outsider candidate, not the big business candidate. However you want to view it or think about it. It's being able to put all your votes into one concentrated vote. Okay? Now, that's voting. Now we got to look at splitting. The whole idea by splitting the stock, the board of directors wants to adjust the price in the marketplace, and they can do that by putting in more shares or taking some out. So in a forward split, We're lowering the price, we're putting in more shares into the market, into the shareholders. It's not a taxable situation, but it's used to lower the price. Most companies don't want their price of the stock to go above a certain level. So when it gets too high, they'll split it to bring it down here. There'll be more shares at a lower price. More attractive, because some investors are fickle and they will not buy into a stock if it's over a certain price. Board of directors wants to avoid that little stigma there. So let's say there's a forward split of 5 to 3. Okay? We have 600 shares, $20 a share. So how many shares are going to be there, and what's the new price going to be? So here's the way you do it. 600 multiply by the first. Divide by the second. Okay? 1,000 shares. You ended yesterday with 600 shares. The stock split took effect, and the first thing in the morning, FINRA is going to adjust the price on the market, and you're going to have more shares. You're going to have 1,000 shares at what price? Okay, so now to figure out the price, here's the dollar of the price, divide by the first, multiply by the second. $12,000? $12,000. Check your math, always. But to get, and this will work for a reverse split too. Same process. To find the number of shares, multiply, then divide. In a reverse split, it's going to look like this. So the math is going to work out. You're going to have fewer shares, but you're going to have a higher price to the stock. Now, that's a split. That is not taxable. Another means to do similar to the forward split is a stock dividend. A stock dividend is every quarter. Every quarter they're going to do a mini split. They're going to issue more shares. They're going to lower the price gradually. In a normal split, in a forward split, the stock price is like this. Right to that. Takes an immediate dive. And now we got it at this price. But with a dividend, stock dividend program, they do it over 4 quarters, and the price is just gradually dropped down. It ends up the same place. In most cases, a bit lower, sometimes a bit higher. Because remember, there's more fluctuation going on, and then there's another adjustment. So they're issuing it 4 times. Which is most expensive? This. A stock dividend is going to be more expensive than to do a split, because a split, one time, boom, we got it right down here all the way. Okay? Again, stock dividend is not taxable. Its goal is just to reduce the price more gradually, just gradually, compared to a stock split, which is about as subtle as a broken leg, right? It's just, boom, drop it right down. Okay? So, that's splits, that's voting, that's setting up your company. If you have questions, hey, talk to me, give me a call.